Hello, everybody. This is Bennett Tchaikovsky, and welcome. Today, we're going to go through some more financial accounting questions. Always exciting. We're going to be looking at recording sales transactions and also preparing multi-step income statements. I am Bennett Tchaikovsky, the accounting professor. This presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without my prior written consent. Opinions expressed herein are those of myself and not my employers, including but not limited to Irvine Valley College and the South Orange County Community College District. Now, with all that fun stuff out of the way, let's go ahead and take a look at the question we're going to be going through and looking at today. So we've got over here on basically on 8/1/24, we've got basically the sales of inventory. Okay, so let's just kind of go through and wrap this up. We haven't wrapped up the problem, just the Excel sheet, right? So when it comes to sales transactions, let's kind of take a step back. So when we're going through and recording any type of transaction, as we kind of remember, you have assets equals liabilities plus owner's equity, expenses, revenues, debits, and credits, right? So this should all really, at this point in time, in terms of how we go through and record transactions, this should look familiar to you, right? An asset's going to have a debit balance, increase with debits, decrease with credits. Liabilities and equity account have credit balances. They're increase with credits and decrease with debits. We record revenues with credits, expenses with debits. Now, with sales transactions, one of the things that you're going to kind of go through and see is that we kind of waited for the first two exams that I traditionally give. The first exam is just to get you used to preparing financial statements. The second exam that I'm giving you generally is going to help you with like adjusting entries. But on those adjusting entries questions, I purposefully did not give you anything involving the sale of inventory. And there was a very specific reason for that. Because when a sale of inventory happens, there's going to be two things that are going on, right? So, right over here. So, when a sale of inventory happens, right? So, if we're the company, the customer is giving us cash, right? We're basically going through and recording a sale, right? And this is from the customer. But when we're selling inventory, right, we're basically giving inventory to our customer, right? So this is the inventory. We're giving them the basically inventory, and we'll say this inventory slash recording and a cost of the inventory to our customer, right? So we basically have two things that are going on. And if you look at a company like the Home Depot, and if I go and look at the Home Depot's income statement, right? So what you're going to notice is in their income statement, you see their net sales, fancy way of saying revenues, right? And we'll see what net means momentarily. Then we have our cost of sales, or how much are those sales costing us to sell? And this is an expense. And this is sometimes referred to as cost of goods sold. Okay, so cost of goods sold is a selling expense. Okay, so cost of goods sold is a selling expense. So when I go through and I'm recording a sales transaction, very important to remember here. I really have a couple different things that are happening simultaneously, right? So I'm going to basically go through is when I go through and recording a sale of inventory, what I'm going to need to do is to record the sale. How do I record the sale? Well, I record the sale with, if I'm selling something for cash or on account, cash or accounts receivable as a debit, and I record sales basically with revenue. So this is going to be my sales revenue. Okay, so I'm recording the sale, which is really talking about the customer gives me money or they say they're going to pay me later. That's the sale part. But when I have inventory, remember it's unique. Inventory is going off of my books, right? So my inventory is leaving my books. So what I'm going to do over here is I'm going to credit inventory and then I'm going to debit cost of goods sold. Cost of goods sold is an expense. So how do I record my expenses? Well, I record expenses with a debit. So when we have the sale of inventory, right? So again, like over here, when we have the sale of inventory, I'm going to record the revenues with a credit. I'm going to record basically the cash or receivable I'm getting in here with a debit. But remember, when a customer, when I sell the inventory to the customer, that inventory now belongs to the customer. So I have to take that inventory, which is an asset, off of my books. How do I decrease an asset? Well, that inventory is going to decrease with a credit. And then how do I go through over here and I got to record the expense? So very much like our friends at the Home Depot, you have your sales minus your cost of goods sold. Okay, so when we come over here to look at this first part over here, I if I'm asking to do journal entries for this, it's pretty much coming from those T accounts. So let's go through and take a look at this over here. We'll kind of use these T accounts to kind of solve our problem. Again, you don't have to do this, but it's going to make it a little bit easier for ourselves. So let's go through and get rid of the Bruin colors before I start giving people a panic attack, especially my USC fans out there. So coming right over here on 8/1/24, PDX, an airport up in Portland, sold 4,000 units to SFO. Was it fentanyl? I'm not sure. Was it animal tranquilizer? Could be. Who knows what it was, but they just sold 4,000 units to SFO Inc. for $300 each. The terms were FOB destination, 315 net 45, and then it tells me that SI received the units on 8/4/24. A couple of things here. What does FOB destination mean? Well, I'll never ask a student that again, but for accounting purposes, FOB means free on board. It's a shipping term. It refers to when title passes to the customer. If something is FOB shipping point, title passes to the customer when the goods are shipped. Okay. As soon as they're shipped, title passes. If something is FOB destination, title passes when the goods arrive at the customer's place of business. Okay. That's what that means. So when I look at this over here, right, FOB destination, what this means is that, well, when I record a sale, I'm going to do it when title passes. So I'm going to be recording the sale on August 4th. Why is that? Because it's FOB or free on board destination. Okay. We got that FOB, that free on board out of the way. Now, what about 315 and 45? What does that mean? Well, it's not 420, net 420. Rather, what it is, if the customer pays within 15 days, right? Is it business or calendar? Depends on the contract. They will receive a 3% discount. but the full amount is due in 45 days, right? So before PDX sells to SFO, they're going to want to go through and do a credit check, right? We want to make sure we know who we're doing business with. We are then going to extend SFO credit terms if it's appropriate. So coming right over here, when we're going through and selling, this 315 refers to the discount. So if the customer pays within 15 days, customer will receive a 3% discount. Okay. The full amount is due or otherwise. The net amount is due in 45 days. That's what that terminology means. So this is very, very important as we're going through and learning how we go through and record sales. So let's go through and look at this first. So I sold 4,000 units to SFO for $300 each. Now, the one thing I forgot to do, and this is actually really important, is that the units cost PDX 182 each. Forgot to add that in there. I'm going to have to go through right over here. I'm just going to pause real quick. Okay. So they receive the units on 8/4/24. The units cost 182 each. So I need to do two things. I need to record the sale, and then I need to record the cost of that inventory going off of my books. So how do I go through and do this? Well, I sold 4,000 units. Give myself a little bit more room here. Let's give ourselves even more room. Okay. So 4,000 units. So basically over here, 4,000 units at $300 cost per unit. My total sale is going to be 4,000 times 300, or roughly 1.2 million. Okay. So when I'm going through and recording the sale, how I'm going to go through and do this is I'm going to credit sales revenue on 8/4/24 for 1.2 million. Because remember, when I have a sale or revenue, I'm going to record that with a credit. Remember, ERDC. I'm recording this with a credit. For every credit, I need a debit, right? So over here now, what's interesting is I sold these, the terms are over here. So effectively, I sold these $300 each on account. Just, I love this. I'm making this up as I go along. This is what I get for writing my own crap. Okay. So right over here. So it's on account, which means that this is going to be accounts receivable. How do I show this customer owes me money? How do I show an increase to an asset? I show that increase with a debit. So I'm going to basically debit accounts receivable for 1.2 million. Okay, got that part down. Now, at the same time, that inventory is leaving my books. Remember, this is a different situation, right? This is gym, tanning, and laundry. It's not that kind of situation. But right over here, we've got inventory going over to a customer. So my inventory is going out the door, right? So this is the sale. My cost of goods sold is I sold 4,000 units, and my cost per unit, or basically this is the sales price per unit. My cost per unit was 182. So coming right over here, my total cost of goods sold is going to be 728,000. Okay, so the inventory is leaving my books. The inventory had a cost of 728,000. And this is also happening on August 4th. Why is it August 4th? Because it was sold FOB destination. What this means is I record the sale when the customer receives it. If it was FOB shipping point, I'd record it on the first, but it's FOB destination. I'm recording this on 8/4/24. So coming over here, my cost of goods sold, which is an expense, I'm going to go ahead and do that over here at 7/28. Now, because I've gone through and I've basically made these T accounts, I can basically do the journal entry. So on 8/4/24, my date, account, debit, credit, what I'm going to do over here is I'm debiting accounts receivable for 101.2 million. I am crediting sales revenue. Remember, when I go through and I'm basically recording this, I have to make sure that I am indenting the credit description, at least for my class. Coming over here. Below this, I'm going to have cost of goods sold. My cost of goods sold is a debit of 728. That's an expense. I record expenses with debits. Inventory is going off of my books. I'm showing this over here as a credit for 728. And this is going to be to record the sale of inventory, right? So we got a lot of stuff going on here. We basically need to record that sale, very similar to when we were performing consulting services in prior lectures. But now we've got inventory coming off of our book. So I have to show that with a credit to inventory, and I am debiting cost of goods sold. Okay, so got this over here for August 4th. I've got a description. We're good to go. Now, now we're going to be dealing with some other situations, right? What happens if someone returns units to me? Okay, so SI gave us back 200 units for full credit. What we have to go through and do is we're basically going to have what we call a sales return. When we have a sales return, it means that the inventory is coming back to us. So, is the full 4,000 units coming back to us? The answer is no. Only 200 units are coming back to us. So, what that basically means is I'm getting the inventory back from the customer. So, my sales return is basically going to be 200 units. Now, if the customer is giving me back units, that basically means they're not going to be paying for me for 60,000 bucks, because why would they pay if they're returning them, right? And at the same time, sales price per unit, total return, and then also I have the cost because I'm physically getting those units back. Okay, so this is 182 was my cost per unit by return of inventory. So coming over here, I've got 36,400. I'm getting back 200 units. Now, when I have a return of inventory, and this is really, really important, I know that the customer on 8/5/24, the customer is no longer going to want to pay me 1.2 million. Why? They just returned 60 grand of it. So I know I'm going to go through here and I'm going to credit accounts receivable on 8/5/24 for $60,000. So I'm going to credit accounts receivable for 60 grand because the customer no longer owes me that money. They've returned the goods. Now here's where things come in. Once I record revenue, I don't touch it. And so what I'm going to do is similar to what we learned about an accumulated depreciation and the adjusting journal entries. What we're now going to learn about how to do is, well, how do we record basically, well, we can't debit revenue. Once you record revenue, you can never go through and touch it. So what we're going to do is we're going to call this sales returns. This is a contra revenue account. Very important. This is going to have a debit balance, right? When you hear a contra account, it's basically the opposite of over here. When you see this here at Home Depot, what does net mean? Does that mean sales on the internet? No, it does not. It means sales minus any sales returns, discounts, or allowances. And we'll talk about the latter two momentarily. So over here, when we go through and do this, we have to use a contra revenue account to record the sales return. So what we're going to go ahead and do is we're going to create a new T account basically over here. And this is going to be sales returns or contra revenue. And this is going to be 60 grand. And this is also going to be on 8/5/24. So we've done part of this. Okay, now the next thing we need to do though is we're actually getting inventory back. Right, the customer gave us back the inventory. So we're going to debit inventory for 36,400. Now, in real life, we could not return it. We would have to call it like a subcategory of inventory, like inventory returns. But this is basic financial accounting. Just want to get you used to recording these types of transactions. So we're going to have inventory coming back onto our books of 36,400. And what I'm going to do over here is I'm going to credit cost of goods sold for the 36.4. Now, this is also, again, a little bit different than with the sales returns. We're not as concerned about it with cost of goods sold, but when you have a sales return, this is what how we're going to go through and record it. So over here, I'm going to record an inventory return. Okay, so whenever I have a sale, this is always the format of the journal entry, always going to be the same. Debit to AR, credit to sales revenue, debit to cost of goods sold, credit to inventory. Whenever I have a sales return, I'm always debiting sales return, crediting AR, debiting inventory, crediting cost of goods sold. That's how I record an inventory return. Now, coming over here, go to the next one. Over here, PI gave SI a sales allowance for being a good customer. Now, what this basically means over here on 8/7/24, what is a sales allowance? Well, I'm basically telling the customer that you don't have to pay me $1,000. So what is that going to do? Well, it's going to reduce my accounts receivable because I'm giving that customer a sales allowance, right? So over here, I'm going to credit accounts receivable for $1,000. Okay, I'm crediting that over here to the customer. Now, for every credit, I need a debit. So similar, I might want to try to debit sales revenue, but I cannot touch it. So I'm going to do over here is I'm going to come over here and say sales allowances. And this is also a contra revenue account. And this is basically going to be for $1,000. And this will also be on 8/7/24. So I'm going to have over here sales allowances, contra revenue account. Okay, so when we are giving a customer an allowance, again, we never touch revenue. It's basically say, customer, you don't have to pay this. You've been a great customer. Oftentimes, these need to get special approval. So we're assuming that that's taken place to record a sales allowance. Okay, so that's how we record sales allowances. Now, the customer comes in here and says they paid the remaining balance owed to PI. So now what we need to figure out is, well, is this customer paying within the discount period? Remember, what does that mean? Well, we kind of said before that 315 net 45, if that customer pays within 15 days, the customer will receive a 3% discount. August 15th is within 15 days of when they receive the item on August 4th. So they will be eligible for a 3% discount. Now, what we need to figure out is to say, well, how much is the customer going to pay us? They are not going to pay us the full 1.2 million. Well, why not? It's because the customer over here, they basically got a $60,000 sales. Assuming they did a return for 60,000, and then they got a sales allowance for 1,000. So what we need to go through and do right over here, basically for this customer, is we need to say, okay, how much does the customer owe us? Well, they owed us 1.2 million, but then they basically returned 60,000 worth of stuff, and then we gave them $1,000 allowance. So the customer owes us 1,139,000. However, are they going to pay that entire amount? The answer is no. How much are they going to go through and pay us? Well, the customer owes us, so the customer right now owes us 1,139,000, right? That's how much they owe us. They're going to receive a discount of 3%, right? So if I take the 1,139,000, I multiply that by the 3% discount, the discount amount is going to be 34,170. So the cash I'm going to receive is going to be the AR, what the customer owes of 1,139,000 less the discount of 34,170. So the cash to be received by the customer is going, or by from us, or the amount the customer will pay is going to be 1,104,830. Okay. So coming over here to 8/15/24, we are going to receive cash from the customer of 1,104,830, right? So I'm going to debit cash. Cash is an asset. I'm going to debit cash. Now, if I credit accounts receivable for the same amount, I'm going to run into a problem, because if I credit this over here, there's still going to be a balance of 34,170. Now, if I'm the customer, like, the customer doesn't have to pay this anymore, right? So what I need to go through and do is I need to credit accounts receivable on 8/15/24 for the full amount due, which is 1,139,000. That balance is now going to be 0. Now, the problem I have with this journal entry is that, well, Bennett, my total debits do not equal my total credits. What do I need to do to balance? Well, I need a difference over here of 34,170. What we're going to call this is similar to what we've come in kind of doing. This is what we call a sales discount. I'll just add this over here. Sales discount. And this is also a contra revenue account, right? So the sales discount is going to be 34,170 on 8/15. I'm going to come over here and say sales discounts for 34,170. So again, once I do this, because the customer paid within 15 days of when they got the goods, right? That's the whole net 315, net 45. So then I can basically say to record receipt of payment from the customer. Okay. So that's how we go through and prepare journal entries. Now, the one thing I'll tell you is that if you're taking my class, how do I record a sale? This is always how we go through and record a sale. Debit AR, credit sales revenue, debit cost of goods sold, credit inventory, never changes. How do I record a sales return? Debit sales returns, credit AR, debit inventory, credit cost of goods sold. How do I record a sales allowance? Debit sales allowances, credit AR. How do I go through and record someone taking advantage of the discount? debit cash, debit sales discount, credit AR. So in this particular case, as you're going through, if you're taking my class, you will have a question on this on your exam. Highly recommend for you to go through and memorize these journal entries, right? Or at least just either use that or use the logic and the T accounts. But remember, you can never, ever touch sales revenue. Okay. Now, with that all being said, let's go take a look at the next problem on the in-class assignment. So right over here, we have Zizix Inc., which is the favorite road on your way to Vegas. And we have the following information taken from its trial balance. And it says over here, assuming a tax rate of 30%, prepare a multi-step income statement in proper form for ZI for the year ended 12/31/28. Now, when we've been looking at income statements for the past two exams, it was simply revenues minus expenses. Gives us our net income, right? This is what we call single step. Now, remember, when we're going through and preparing financial statements, we're not preparing it for me or you, we're preparing it for the investors. And so the multi-step income statement is particularly useful when we are going through and selling inventory. What you're going to notice here is you're going to see the term net sales. Again, that's not net, that's not internet sales. That's sales. That's any sales returns, allowances, or discounts. Gives us our net sales. Then I subtract cost of goods sold. This is going to give us our gross profit. That's not our disgusting profit, but that's the profit we're making off of the sale of our inventory. Very important as a retailer. How much of a markup am I going through and achieving on the sale of my inventory? From that, we subtract out selling, general, and administrative expenses. By the way, you're going to see many different ways of going through and preparing income statements across all different companies. Then what you'll see over here is you'll see operating income, because that's income from operations. Then you're going to see other income or expense. What this is interest expense, interest revenue. That's not a part of our normal operations, right? So we're going to put that as other income or expense. This is going to give us our earnings before income taxes, less our taxes is going to give us our net earnings. Let's go through and take a look at the question. So right over here, this is single step. I'm asked to prepare a multi-step income statement in proper form for ZI for the year ended 12/31/28. So I'm going to say ZI income statement for the year ended 12/31/28. When I'm going through and doing a multi-step income statement, I'm going to start with sales. Okay, so my sales over here were 350,000, but I need net sales. So I'm going to say less sales returns, sales allowances, and sales discounts. And this is going to be my net sales, or you can say sales net, meaning that I've subtracted out the sales returns, allowances, and discounts. So coming over here, I've got sales returns, sales allowances, and sales discounts. Just pulling it over here. These have debit balances. Why? These are contra revenue accounts. So they're going to have debit balances. So coming over here, my net sales or my sales net was 304,000. So that's the first thing I have to do. What are my net sales or my sales net of the allowances, returns, and discounts? Now what I need to do is I need to say less cost of goods sold. How much did those sales cost me? Remember, I'm selling inventory. So I'm going to come over here and see, oh, cost of goods sold was 90,000. So my gross profit, that's not disgusting profit, but my gross profit, meaning that what did I basically make off the selling of my product, is going to be 214,000. So I'm just indenting here so you can kind of go through and see that I'm doing a calculation. When you're going through and preparing this, remember, we don't use debits or credits, but I'm just showing this gross profit over here to so you know that I basically this is how I calculated it. Now we're going to then say less selling, general, and administrative expenses. Okay. So my selling expenses over here were 42,000. My general and administrative expenses were 70,000. So my total SG&A are going to be 112,000. When I subtract the SG&A from the gross profit, this is going to give me my operating income. That doesn't mean I'm performing surgery. It's how much did I make from my normal business operations. Okay. So now that I have this, I'm now ready for the next step. Less other income slash expense. So coming over here, I have other expense. My other expense over here, or my interest expense, was 19,000. So I'll just call this over here interest expense. And we'll say this right over here so we know it's going to be subtracted. And then we have interest income. And by the way, the brackets mean a negative number, right? Don't be afraid of it, right? So it just basically means it's a negative number. Income, my interest income is going to be my interest revenue, interest income, same thing is going to be this. So my net other income slash expense is going to be 9,000. Okay. So when it comes to this part over here, so now I've got my net income or my basically my net other income expense. So my net income or my income before income taxes is going to be 102 minus the 9,000 or 93. Now, I'm going to show you a little trick right now that we want to go through and use to make sure we're doing these questions correct. As you see this over here is 93,000. And effectively, what is this? It's basically our revenues, which were 360,000 less our expenses. Now, if these are all in fact expenses and I take 360 minus 267, I get 93. So this is a way I can go through and make sure I go through and check my work. So this is my income before income taxes. Now, it tells me over here that my income tax expense, or basically assume a tax rate of 30%. So over here, I'm going to say then less income taxes. This is going to be 30% of 93,000. So my net income is going to be 93,000 minus a 27.9 or 65,100. So that will be my solution for this particular question. So we're kind of like in terms of inventory, this is actually one of the most important things you can learn prior to going through and taking managerial accounting. From financial to managerial is a multi-step income statement, because when we're dealing with multi-step income statements, you're literally going to see it in chapters 14 or in basically the regular managerial, like the job order costing, the predecessor to that, absorption versus variable costing. You're going to see it everywhere. So this is knowing how to do a multi-step income statement is really important. But remember, instead of just revenues minus expenses, we're basically showing, well, this is how much money I'm basically making off of my inventory. So we call gross profit. I then basically subtract out my operating expenses. That's going to get me to my operating income. Interest revenue, interest expense is really not part of my operations. If I'm borrowing money, if I'm lending money to people, that's going to be an other income slash expense. It's not a part of our normal operations. That's going to give me my earnings before income taxes. I subtract my income taxes, and then that's how I get down to my net income. So that's the problem for today. I want to thank you so much for being here with me, and I look forward to seeing you on the next video. Have a great day.